and welcome to the latest Retire Well episode with me, Matthew, and as always, I'm joined by Joe. Today, we're going to talk about cash flow modelling, which is one of the tools we've got in our toolbox to help people model retirement and to be comfortable entering retirement, and then as they go through retirement, we use it to ensure that we're on track. So we'll kick off and let Joe jump in with a little bit more about cash flow modelling and what goes into it.
Yeah, I mean, I believe that cash flow modelling really underpins good financial advice. You've got the investments, but I think equally important is looking at that long-term financial plan that can be represented sometimes visually through cash flow modelling. I think it's sort of general context, it's something that's a lot more prevalent in the industry in recent years. Now, I think over 90% of advisors use cash flow modelling in some way or another.
Certainly the good ones.
Yeah, certainly the good ones. But yeah, I think it's something that's really useful. And what we're going to do today, as Matthew said, we're going to look at what it is, what's it mean, and how it can be useful for yourself.
Yeah, definitely. I've had lots of people come to meetings and have their own spreadsheets, their own plans, and their own almost sketched out what retirement looks like. What we do with cash flow modelling is we feed in all the assumptions, so things like inflation, growth rates, people's assets, people's values, and then their income needs to almost more accurately show them potential scenarios. So different growth rates, almost potentially killing someone off early. Again, we can then ensure that their financial plan works for them and it can really add value, especially for those visual learners who almost want to picture what retirement looks like. And for me, I think cash flow models give people the confidence that actually, especially on a low growth rate, it might be a negative growth rate for the rest of their life, that lets them confidently say, okay, I can afford to retire, because again, as we've talked about in previous episodes, that can be a challenging point to get to.
Yeah, I think the big thing about cash flow modeling, I suppose in a nutshell, it essentially ensures that your income today is sustainable, and then it tries to look forward to make sure that your future income is going to be sustainable. I suppose it's almost a bit like self-marking the financial plan that we've put in place, so you can speak through with clients about what the plan is with regards to income, what the plan is with regards to pension contributions. You can plug all of that into a cash flow modelling software and self-mark, say, is it going to work? If not, what do we need to do? And I think even though sort of sometimes it is just about sort of marking the income, the other side might be looking at helping facilitate decision-making process.
Yeah.
So a lot of time clients can come to ourselves and they'll say something like, can I retire? Am I able to do these holidays, do some big expenditures? And by sitting down and running through a sort of cash flow planning process with them, you can start looking at those different scenarios and what's the potential knock-on effects that you might have to the longer-term financial plan.
Yeah, definitely. I can think of a client in my head who, when we first talked about their potential retirement objectives, they wanted to move house and there was some money that needed to come out of investments and pensions for that. They also wanted to spend 6 months of the year abroad in Cyprus, so they were seeing themselves as needing more income for that. And then they almost said, I don't really quite know how much I'm going to spend in retirement, so can we model this income, this income, and this income? Again, for me, it's a harder one to come at and almost try and say, well, are you really going to buy a new house and spend half the year somewhere and spend this more income? But actually, we could then present the different scenarios, and I think that really adds value, and it confidently allows someone to say, I'm ready for retirement. And as you've described, it's also really good to say, okay, drawdown, for example, could meet your income need here, but you might also be able to purchase an annuity, which is a guaranteed income, and we can look at the two together, and then with that we can say, what adds more value? Is it the guaranteed income or is it the flexibility? And visually we can show the impact of that for people.
Yeah, absolutely. And before we just come on sort of more of the reasons why cash flow planning I think so powerful, I thought it would be good to almost just break down what actually goes into a cash flow plan and what you should be thinking about when putting it in. The first sort of thing that we'd look at is your current situation. So that would be looking at what value of pensions you have, what value of savings you have, what's your current level of income, and what's your current pension contributions that you might be making. And that'll start to allow you to look at what your base is and sort of what your starting point is. After that, you want to then look at your expenditure. So how much are you spending? And you can break that down into what's essential, what keeps the lights on, what makes sure that you're not just having, I mean, maybe this would be just eating rice and beans. And then what's your discretionary? What are the things that are going to make you actually enjoy retirement, meals out, holidays, that sort of thing. And in that, you can actually look at capital expenditure. So do you want to plan to have a big holiday away as soon as you retire and take the rest of the family there, potentially with some tax-free cash? So those are the sort of the two main things that will sort of continue on. Do you want to look at the other bits that go into it, Matthew?
I was just going to say on that bit, I think the more, like any conversation with a financial advisor, the more detail you give and the more detail goes into the model, the more useful they are. So if someone said, okay, I'm not willing to share the information, I've got £500,000 in a pension, I want to take £2,500 per month. Okay, that's quite a simple model. If someone actually said, okay, well, look, I've gone through my bills. This is what I spend. I want to build in a bit of extra. Here's the data. That can go into the model. Plus, you can then say, okay, this is what I think my house is worth, but I think I've also got a mortgage of this amount. I'm currently paying it off at this rate. Again, the model can then have more detail and be more useful. And the more you add and give, the more value you can get from financial advice. The other bits that factor in are things like growth rates and life expectancy. So life expectancy obviously isn't an exact science. So we look at it from the ONS to say, what is someone's average life expectancy? And if that's somewhere between 84 and 87 perhaps. But when we're doing these models, we're going all the way to 100 because we have seen clients live to that point, and you don't want to get to one day past your life expectancy and then suddenly you say, okay, well, you've now outlived your model, so you haven't got any flexibility, for example.
Yeah.
The other thing is almost inflation and growth rates.
Yeah, I was just going to say, I think that's a key point that you've made there with regards to what you should do when doing cash flow modelling. And to be honest, wider financial planning in general, it's always better to take the conservative view, the almost not necessarily worst case scenario, but close to it of, if I was to live to 100, am I going to be able to afford it? If, for example, you look at plugging in inflation and growth rates, if inflation was 5 or 10% in a number of years, like it has been recently, am I still going to be able to afford retirement? And growth rates are an interesting one. So inflation, generally, you'd look at using sort of 2%, 2.5%, something like that on a long-term basis, which is the general assumption. Growth rates, you can look at it in a few different ways. Some people might look at using growth rates from previous years. So I've seen some people do cash flow models that look essentially modeling as if you've had the exact same investment returns that have happened in the previous investment 30 years. Then what would it look like going forward?
Yeah.
I suppose the potential problem with that is past performance isn't an indicator of future performance, and although there is some repetition in markets, it's not going to be exactly the same.
Yeah.
The other way that you could look at it is look at a set amount of return each year. So that might be 2, 5, 8%, dependent on sort of what level of return you feel. Issue with that is returns aren't linear, so you don't get sort of the ups and downs of the market as you do on a day-to-day basis.
Yeah, definitely. I think financial advice and cash flow modelling is an art, not a science. So we come at it at the view of, once we've identified someone's view on risk, we can then best match the potential growth rates and then say a low growth rate, a mid growth rate and a high growth rate, all factoring in inflation, showing different scenarios. And then the one that I really like to do as well is to add in a stress test. So if we replicate something like the 2008 market crash, again, you had period of market volatility and then you've had a recovery off the back of it. So you can factor that in to say, if we put that in and that's almost like a worst case scenario, does your financial plan work through it? The other thing, we've done in the past where people have had ill health is to potentially, stop income sources, potentially, killing someone off. And people find that very valuable in the sense of, if someone's main objective is to protect for loved ones, they want to see what their income sources that they will be leaving thereafter. So again, that can be really valuable.
Yeah, and I think that comes again back to points we've explored previously on looking at a household when it comes to retirement as opposed to one person.
Yeah.
Because if you look at just one person who might have the majority of income, and it might, to be honest, come through a final salary pension where they may get 30,000 a year. On their death, it might reduce to £15,000.
Yeah.
And although expenditure might go down because there's only one person, you might have children that you still need to care for. and it wouldn't reduce by that much. So I think what Matthew said there with regards to stress tests, you can build whatever you want in there. It can be inflation higher or growth low. It can be killing someone off a little bit sooner. It could even be the case of if you're looking at sort of a planned capital expenditure like a holiday or something, what would it be if it was 15,000 or 20,000 when it comes to it?
I think the more detail someone has in their plan, the more useful it can be. So I've got some clients who they've said, okay, we think we'll upgrade the car every 3 years and we think that's going to cost us an extra £15,000. So as well as our regular income, let's put that spike in. Again, that just helps to be more accurately aligned with they see their expenditure, and it's not going to be, oh, actually, I was planning to take £2,500 or £3,000 per month. Oh, I hadn't thought about a new car, and then throw that in, and that's using capital that isn't built into the plan. So for us, it's very much about trying to be as useful as possible. I've had someone in the past who said, I think I'm going to need a hip replacement, and I've researched that's going to cost an extra £15,000 or £20,000. Can I factor that in 3 years' time? Again, completely fine. In the same way that you might say, I've got a wedding coming up for my son and I want to give some money, or I want to leave some money in trust for a grandkid, so I want to allocate that to the spending. So you can have as much or as little detail when it comes to that bit, but again, it factors into the decisions of, can I afford to take this much income and can I adjust it? Some people, when it came to things like the cost of living crisis, would say, okay, what is the impact on my assets if I take an extra £500 per month? And we can put the two side by side and we can then make an informed decision.
Yeah, absolutely. I mean, we've spoke there about sort of almost the decumulation side of financial planning, the post-retirement. I think equally it can be just as powerful looking at sort of coming up the other side when you are still working. If you've got a set amount of income that you might want to receive in retirement, you could almost take that income and then work back. Because if your current level of savings, when it's projected forward, won't allow for that income, what can you do to get there? Is it going to be a case of making X amount more per month contributions?
Yeah.
Is it looking at sort of putting some of the excess capital that you might be saving now into investments? I think, at its heart, it's essentially looking at identifying where surpluses and deficits are, and how do we almost shift the money around to make them work?
Yeah, 100%. I think the idea of putting £500 into a pension at the age of 30, you might say, oh, well, what's the benefit going to be? And then some bright spark like Joe can say, oh, I'll model it. And therefore you can then say, look, this grows up over time to give you a pot that when you get to retirement age is £500,000. Suddenly that person then goes, oh, actually, I think I could put an extra £20 in. And you can then say, oh, well, that impact over the long term is quite significant. And that can really start build the good habits that financial planning is all about. Yeah, so I think both in the accumulation and the decumulation, it makes a lot of sense. I think it's also really powerful for things like a big thing like selling a business. Again, someone's used to a business producing income. Suddenly they've got a lump sum capital comes in and you say, how does this money last me for the rest of my life? What do? Well, we then say, this is what we should do from a tax planning point of view and invest it into, and this is how we can provide you with a sustainable income that you want. You then show that and you say, okay, well, that can actually mean someone can confidently, accept an offer for a business rather than saying, how much money am I going to need for the rest of my life? I don't know. They can get a little bit more of a science to their plan.
Yeah, and I think one of the important things as well with regards to cash flow planning is it's not a do once and forget. It's malleable. You'll come back to it at least every year if you got a financial advisor, look at changing it. And I think that's where it can be quite beneficial if you've only just started retiring and you've maybe set a more conservative amount that you're wanting to draw from your pension. After a number of years, it might look like it's going to last your life quite significantly. So you might have a few £100,000 left at the end of the plan at age 100. So that's when we can start sort of speaking to clients and saying, look, don't worry about it. You can actually start taking a little bit more. And that's something, I suppose, with regards to when we were talking about behavioural biases last episode, where people might not feel as comfortable spending their own money. So if you look at that and essentially say, look, it is going to work, you can take more, then that just gives them a little bit more of peace of mind to know that they can do it.
Yeah, 100%. I think also you can have too much cash flow. You can have death by cash flow in the same way that you can have death by PowerPoint. And you can say, I want to tweak very small things and the end results are very similar. But I think certainly for people being psychologically ready for retirement or picking a sustainable level of income, I think that's a brilliant starting point. And like you say, if a plan changes, it can be modelled. If someone won the lottery, again, suddenly you say, how much money can we afford to spend? And that can be factored in. A recent episode, we talked about pensions on divorce. Again, if someone goes through a life-changing event, such as someone passing away, an inheritance, or something like a divorce, that's when having a new model and almost starting to work through this process with someone like ourselves could be really, really valuable.
Yeah, absolutely. Another sort of strong benefit of cash flow planning, if you're doing it with an advisor and you've got maybe a bit more of a complex, comprehensive cash flow modeling system, as opposed to just an Excel spreadsheet or drawing stuff out on a page, is that you can look at how best to maximize tax efficiency. Yeah. Tax efficiency in 1 year is one thing, and it's something that you could probably work out yourself in terms of, I need to use my personal allowance, I need to contribute to ISAs. But when you're looking on sort of a 20 to 25, well, however long you're going to live, time horizon, you can start looking at what's the best way that I can look to draw from my pensions, what's that impact going to be, which pots do I need to take out from when, as Matthew likes to talk about, what tap should I turn on in retirement. And then, do you want to say something?
I was just going to say, and I think that then definitely encouraged the long-term thinking. And like we talked about in a recent one about the psychology of investing, it moves away from the media and the market-driven thinking and does become okay, what I'm thinking long-term, the plan works. If something happens like Trump and the tariffs, that doesn't impact my decisions because I know this is building in the long-term sustainability. So I think, that is really, really crucial. And I think, it can be the difference between someone feeling like they can retire or not, because you can present them with the scenario where evidence-based shows that they can do it. So is now the right time to jump in for some examples, or have you got more to talk?
Yeah, just before we jump in, I thought it would be good to just talk about sort of when you are happy and you've got that cash flow model that looks good and you've got plenty left at retirement. That's when some clients might look at almost switching the thinking. They're happy with them, they're set for their retirement and they're set for their life. They then want to start thinking about what happens when I die and what happens to the fund, who's it going to pass to. Yeah. Recent changes or proposed changes, to inheritance tax and how they might bring in pensions. Cash flow planning can sort of help look at that on how much are you able to give away from your current assets to help reduce your estate on death while ensuring that you've still got enough to maintain your current financial plan. So I suppose that just...
I think that's perfect in terms of the chapters of retirement. You might have a first chapter of retirement, which is very much about finding the balance and finding the income. Then you might have done a lot of your bucket list, so you might start to reduce your expenditure. And at the point that you reduce your expenditure and things like the models are showing lots of excess capital, that's when someone's secondary or third objective might be to pass on wealth to the next generation. And at that point, we can model the idea of putting money into trusts or giving money that way, which I think is that really good matching your priorities, but equally providing your own short-term stability as well.
Yeah, absolutely. And again, that just reiterates the benefits of holistic financial planning. Make sure that even though at the moment you might be focused on pensions, what are the knock-on effects potentially going to be in the future? Okay, so I'm pretty happy with that sort of running through how it's valuable. As Matthew said, we're just going to start to run through just a couple of different examples of how you might use cash flow pre-retirement. For people that are watching on YouTube, we'll chuck up a couple of graphics just so you can follow along, but we'll try our best to sort of describe what's on screen and what we're looking at. The first
through the medium of dance, through the conversation.
The first cash flow scenario we're going to look at is someone pretty close pre-retirement at 49, wanting to retire at age 50, and the different bits that we look at is he's currently got 60,000 in income, wanting to only spend 40,000 in retirement, so a drop which is quite natural in retirement, and then further dropping again when they get later into retirement. At the moment, they've got £200,000 in DC pensions, so the flexible pensions that we've spoke about previously, 200,000 in an invested stocks and shares ISA, and then a small defined benefit pension of 5,000 per annum that would be payable from age 60, which would essentially incorporate a lump sum of 20,000 as well. So looking at this, essentially from age 49 that they are now to age 57 when they're wanting to retire, everything's covered by their salaried income. They're pretty happy with that, and it essentially meets their needs. After that, they've got a little bit of gap between now and state pension age, which is what they need to fill. Some of it's filled by the defined benefit pension, and then the rest is going to have to start coming from that sort of flexible income that we've spoke about there.
Yeah, so this chart shows along the bottom the age. So as they get older, closer to that 100 figure that we've looked at, and then along the side there, we've got the income levels that Joe's described. And then like a cake, we've got the different layers with the different colours. So yellow sticks out there as being a state pension that then starts and then grows in line with inflation. We've got the sort of greeny colour, which is the employed income. And then we've got the withdrawals from investments, which are the blue. The tax-free cash is that extra sort of brown lump. And then we've got the defined benefit pension, which is the peach, and the brown sort of withdrawals from the pensions that we use to meet those needs. Again, this is the tax efficiency of using this model to provide the income.
I think the bit that's interesting here is when you do almost flip it around and look at the underlying pension benefits. So they started off at that £400,000 mark, and it's going up as they're still employed, they're making pension contributions, reaches that sort of, I think it's £600,000 mark, and then they slowly start drawing down on their pensions. And then this is where we'd start looking at a client, go, yeah, it's sustainable on the growth rate that we've used now, but what would happen if we were to make it a little bit less, make it not quite as good of a growth rate? Would it still last? If so, that's when you can start having conversations on, do you want to spend more? Do you want to start looking at gifting away and helping people like your children to purchase a house or something like that?
Yeah, definitely. And when we look at this chart again, there's a clear element when that brown bit's the flexible drawdown from the pension reduces. And when we look at that on the asset basis, we can see how that accumulation is seeing the funds run down. And then you can see, from age 84, there's no flexible funds left. The average life expectancy for someone is probably between 84 and 87, depending on their age and where they live now. So they might see that and say, okay, well, I'm going to spend a lot less in my 80s, so I'm very comfortable with that approach. But again, it's a talking point. It's a view of, do you see yourself spending less in the later years? Do you want to borrow from the later years to have more income in the early years of retirement?
Yeah, I think some people, when they sit down with financial planning, would look at that and probably jokingly say, well, if I make it to 84, I'm pretty happy and that's a life well lived. But others might look at it and be a bit more concerned and feel like they're going to live forever and make sure that they want it there. So then again, we look at this where potentially it doesn't reach to that age 100 when we're wanting to be a little bit more conservative with our investments and look at what else can we do. So the next slide, which we've just brought up there, is looking at one potential thing. Instead of retiring at age 57, one thing that they could do, push the retirement back 5 years and work all the way to 62. And that quite easily makes it a sustainable retirement. But then that's when you've got to start thinking about the other things. Although it would make sense to work to age 62, how do you value those sort of 5 years of working, or are there other reasons why you might want to retire before then?
Yeah, definitely. And I think that's when in the next scenario, we've looked at the idea of part-time work between 57 and 62 to almost match some of it from income and then some of it from flexible withdrawals, and that can squeeze out the longevity of the plan on that example to 94. I think the other conversation you'd be having with a client there would be to say, do you think you'll spend less in the later years? Are you willing to drop income down? And in the same way that we see, clients having that first golden years of retirement spending more, we then often see a phased approach. People often go, okay, I've hit state pension age, but I also don't think at that point I'm going to be spending as much as beforehand. And equally, there might be some magic numbers like 70, 75, where someone says, my foreign holidays are going to be less. And equally, someone might say, I might sell a house, I might release some equity, or there might be a future inheritance that might factor into a plan, or not factored in, but almost inject some capital in at some point. So I think for us, that's the flexibility to model things, but not be fully reliant on that. I wouldn't necessarily be saying to that person, you have to work to 62. I'd be more saying, do you see the value in working longer? to have a guaranteed income of this amount throughout your retirement, or are you happier that you'll spend less and there'll be a balance between the income need and when do you retire?
Yeah, I mean, we ran through them quite quickly, but hopefully just gives you a little bit of an idea of sort of what it would actually look like on paper. I essentially, as I've said, I see it as almost a what-if scenario and almost just a starting point for a conversation. As Matthew said there, just because it says it's going to run out at 84 doesn't mean it will. In fact, I'd say 99% of cash flows that you do are probably going to be wrong because you can never get the exact assumptions correct. So you might get better growth than expected in some years, you might get worse growth. But I think it's very much just about helping drive a conversation about what are your feelings, what are your objectives, and what ultimately are you wanting to achieve with your money.
Yeah, it puts meat on the bones of the conversation and makes it a bit more real, and it can really be a key conversation with an advisor. And as you say, I would say 99% of models are definitely going to be wrong because we don't know exactly what returns are going to be like. We don't know how long someone's going to live for. But what we do know is that we're on the right sort of pathway. The idea of if funds ran out in someone's 70s, you might say, okay, there's a problem. Are you willing to go back to work in your 70s? No one's ever said yes to that to me. So that's an element of, can we take less income or do we have to work for longer? Again, those are the trade-offs that you can borrow from later life, or you might say, oh, that's fine because I see myself downsizing and releasing a few £100,000 into the plan in my late 60s, and that then keeps sustainability going. There's always a plan B, a plan C. We're just almost looking for what it could look like on plan A and then saying, okay, does this best match what you want to do? We've had some clients over the last few years where the cost of living crisis has bitten a bit harder, and they've said, can I take a little bit more income? And we've modelled it and we've said, no problem. We've had others who've said, can I spend more on holidays? We've modelled it and we've said, it's a bit tight. You might be worried about, having the sustainability. And they've said, okay, thanks for telling us that's how financial advice works. And we can then say, we'll just stick with what we're spending rather than taking the extra.
Yeah, I mean, I think the next bit I was going to come on to there was sort of risks of cash flow planning and where it can go wrong. And you've almost answered it in talking about the good bits of financial planning.
Yeah.
It's only as good as the assumptions that you put in. As Matthew said, if you don't sort of fully disclose what your plans are and look at the growth rates and assumptions that you should use in, it's not worth the paper it's written on. The other thing is sort of not having a plan B. If you look at one cash flow and it looks like it's going to be sustainable, and you go, yeah, cool, let's click the button, let's retire, and there's no plan B there, when stuff goes wrong, that's when you might come and go, well, actually, I need to return to work or something like that. I think it's just about making sure you've got all your options available to yourself.
Yeah, definitely. I think it's that long-term plan and it's having the flexibility. When George Osborne announced pension flexibilities, lots of people then said, okay, I can vary my income in retirement. And for us, lots of our clients really, really value that. But equally, when they first entered retirement, they couldn't have predicted how those things would change. Again, sometimes it's spending more on family members. Sometimes it's almost saying, I've done a lot of my living, I've done a lot of my holidays, I'm ready to start gifting some funds. And other people are almost saying, there's been a change in a life event and I want to turn on another income stream. Or equally, I've now got another income stream. It might be a rental property. Again, I'm going to turn down my pension, and we can see the impact of that. So for us, it's a really good tool, but it's definitely to be used in conjunction with wider conversations and a wider, what is someone's objectives? And as you describe, the more useful information that can feed in, the more the conversation and the relationship with your financial advisor can help talk through plan A, plan B, and can give people the confidence in their decisions.
Yeah, absolutely. I mean, I'm pretty happy with what we've covered there. Do you have anything else to sort of add before we wrap up?
No, I don't think so. I think anyone watching this thinking, oh, that's really useful, I'd like a financial model or a plan for my life. Again, that's one of the values of financial advice. So definitely get in touch. I've had some really good spreadsheets that clients have built, but some of them do miss some fundamental things. I've had someone who said, look, I can afford to retire on this income. And then you say, okay, where's inflation? And they get a bit sheepish. So again, part of having this conversation is to build upon what people expect to spend and then to almost give them the reassurance that a long-term plan can work. So I think financial advice is, really important to be hand in hand with cash flow modeling, but it's also flexible. You can't almost pin everything on just the model alone.
Yeah, absolutely. I mean, I was going to summarize, but I think you've done it pretty well yourself there, Matthew. So I'll just remind everyone, if you've got any questions at all with regards to what we've discussed in this episode or previous episodes, please leave comments down below. We're always interested to know what people are thinking. We've got new episodes every single Tuesday, so look forward to seeing you then.